Welcome to another episode of Equity Mates on AusBiz. My name is Bryce, and as always, I'm joined by my equity buddy Ren. How are you going?
I'm good, Bryce.
That's
good to be
good.
back for the second part of this four-part long-form interview.
Yeah, next a bit sore.
I think I'm going to have to ask AusBiz for a separate couch next time, though.
That's right. We are back with Managing Director and Founder of Macro Investment Group, Conrad Song. Conrad, welcome back.
Good to be back.
Yes, we have a big episode lined up today. There is no hotter conversation in the Equity Mates community than brokers. Every day on our community group, what broker should I use? What broker should I use? What broker should I use?
Our number one DM is, what broker do you guys use? Which one should I sign up with? It's a big question. And it makes sense these days because there's so many new entrants coming into the market. So I guess let's set the scene and then let's talk about the race to the bottom. So set the scene for us. What's happening in the broker landscape in 2021 in Australia?
Yeah, great question. And I can understand why people are very keen to learn about it, because it's like a decision you make. You set it up and then you kind of forget about it, right? Because it's done and done. To change, it's very annoying and frustrating, although you can make a HIN transfer. But like anything, for people who are new to the market or even those who are existing investors, it's a big decision just to get out of the way, and then you want to do it right. So so first thing is there's different types of brokerage, right, that gets executed in the Australian market. So the key ones that we're seeing is you've got the self-directed trading, which is predominantly, well, historically it's been predominantly ComSec that just led the charge. They were charging what, $20-30 a trade,
$20, yeah.
They were from a big bank, right, CommBank. So and then you had advisor assisted brokerage, and that always had a premium or full service broking, right? Yeah. That's the industry that I came from, and that's one of the divisions that we offer at Macro as well. Companies across Australia charge very different rates for that. So I guess that's the first thing. Investors should try to evaluate what type of advice or even trading execution advice that they want. But I think what most people are asking when they say, hey, through your DMs, and they go, hey, like I'm looking for a broker, I think they're looking for the self-directed broker, right? Definitely. And so I guess the issue is that, well, I spoke about this on another channel, and it's pretty crazy, right? You have this race to zero, which makes sense. Technology is supposed to make fees lower because products get more scalable, and if they're more scalable, they're cheaper to run, and as a result, that discount should be passed on, and just natural laws of competition, people want more market share, and that's what you're seeing now. We saw it obviously happen first in the US, and now we're starting to see it happen more in Australia, and there's some key players right now really racing that, pushing that race as quickly as they can. And there's impacts to that. I think one of the things is that investors get this strange idea that, well, firstly, I have to say, $5 a trade or $0 a trade is not going to make you any money, right? If we're assessing a trading platform in the vacuum of a trading platform, sure, a cheap trading platform is important, but then it's like, what do you miss out on that as well? There's a lot of things that you miss out on that generally. For fintech startups that are out there, and I won't name them, but people know who they are, that are charging this, their platforms are they're in their infancy compared to a lot of the other platforms out there. Yeah. Whether it's the tech behind it, whether it's the robustness behind it, and then you have the actual problem of like chess and issuer sponsored as well. So I guess it really comes down to how you guys want to look at it, but yeah.
We always play a game, and I've got to throw it in here, but you've mentioned full service brokers there, and we often ask our experts on the show, overrated or underrated full service brokers, and given that you're from the industry, I'm pretty sure I know which way you're going to lean. But overrated or underrated full service brokers?
Actually, it's, well, I mean, my shareholders would probably not like it if I said they were overrated, right? But no, well, it's one of the major problems that I tried to solve by starting this company, right? So I came from the full service stockbroking industry, and well, at that point, I thought it was very overrated, right? People were making decisions based on someone's crystal ball idea, and you know the rate and also the value, the perceived value of this advice and the trading execution premium that they add on it was just warped. I think at the end of the day, what people and clients and investors need to understand is that brokers don't know anymore, right? But they have access to more resources. They spend more time. They're on the pulse. And like any other job, they work really hard at it. So it's like if I was to get my apartment cleaned, sure, I could do it, right? And I could fit it in lunch or after work and come home and do the deep clean and get it done, right? Or I pay someone to do that. Now, what do I expect if I pay someone to do that? Well, one, it allows me to have a significant, more time to do other things. And also someone who's dedicated, whose job is that, they've done that for some time, they've got the experience, and as a result, there's that value. So it's the expectation of what the client is expecting. If you're expecting the broker, just because you're paying him a little bit more money, to have a higher strike rate than you, well, I mean, maybe your expectations are wrong. I think one of the big things that we I think we communicate well to our clients is that we're trying to transparently provide you with support and advice. And if you lose money, it hurts us just as much. And a lot of the critique in the broker industry is that, oh, well, the broker doesn't lose any money. And it's true, right? At the end of the day, it's how the industry is set up. And that's why we're trying to shift towards, and you're seeing the industry shift towards self-directed value, creating the mobile application like we're doing, or the fund where we actually do get penalized, or we're trying to provide value to the end user. But ultimately, like you just have to understand what you're paying for and what you're actually committing to. And that's to have someone work their absolute asses off to try to find the best strategy and the best stock for you. And that's where credibility is key. And that's why it's a much longer onboarding process for full service clients, because it's about getting to know, I guess the business and the values that we have and the morals that we have. And sometimes it takes a little bit of time. And you'd actually be surprised. It's usually the companies that have a strong reputation and a big brand that take advantage of that, right? And end up having clients that are just kind of, not getting the service they want. So it's I wouldn't say branding's the only thing. Not many people know who Macro are, but we've grown our funds under advice considerably, and it's mainly not only from new clients, but it's from existing clients referring new clients, but also existing clients bringing on more money onto the account with us because they're happy with what we're doing.
So we won't say overrated or underrated. We'll say fairly rated, depending on who the broker is. Yeah,
that's a good answer.
But getting back to I guess the area of the broker landscape where Bryce and I more play, which is that self-directed online platform. You mentioned that CommSec was the dominant player in this space, and then we've seen, the Stake, Pioneer, $0 US trading, Superheroes come in with $5 ASX. We've seen Sharesies come across from New Zealand, very cheap. One debate that constantly, I guess, floats around in this circle is the question of chess sponsorship. Do you want your shares chess sponsored on your own HIN, or is the custodial model fine? How do you think about that question? Because depending on who you ask, you can get wildly different answers.
So it's interesting. So all of those companies sit or used to sit on the same AFSL, which is Sandland Private Wealth, which is where we sit, right? Superhero sat on them, Stake do still sit on them, and I think Sharesies do as well, right? So this conversation is happening in closed doors plenty of time. And I've been privy to those conversations, and the reality is that so the reason why low-cost brokerage can be passed on is because of the custodian model, right? People think, oh, they're not making any money, right? It's $0 a trade. No, they're making money. No company, no organization, unless you're a charitable organization, is going to run through a business model which doesn't make any money. Now, the other thing as well is you've got to understand is that, sure, it might be a loss-making service, but there's always somewhere that they're going to take the clip, right? That might not even be in the trading execution. It's no wonder that companies, and I won't name them, but there's no wonder why a lot of companies are coming out with other products to add on to their offering. Add-ons, right? So, everything is about being a freemium model. Now, I'd be lying if I didn't say that's attractive for us as well. Well, we're a financial services business that started from a very traditional point of view, and now we're adding the lower barrier to entry models. So we've got a trading platform that we're about to launch at. So we've got a trading platform now, which starts at $14.95 a trade. And then everyone went even further. I was like, okay, fine. We're looking at setting it up at $5 a trade. Now that tiers up, and similar to most of our competitors, it's at 5, then 10, then 15, then 0.1%. But that's on HIN, right? That's Chess sponsored.
Yeah.
And as you guys already know, and I won't kind of go through all the intricacies of it, but Chess it's on your own name, and HIN issue is not. So there's massive black swan events that will cause your money to be at risk, and you'll come after creditors, right, in a liquidation or in an administration of the business, right, because your capital is held with them. It's not held in your own name. So again, that's massive black swan events. And so if you want to price that into your risk premium, you should. But at the end of the day, issuer sponsored has been around for a long time as well, and it is good, and it works. But it's the only way to offer that discounted price. But just understand that the money is being made somewhere, and if it's not being made there, is because it's a loss maker. Then the money will be made somewhere else. Yeah. Just as long as you're aware of that, I guess it's I think the major issue with a lot of these companies, and not to be the voice of reason here, but the major the major risk is that it almost feels like tobacco companies, right? Going to 18-year-old kids who've just turned 18 and said, "Hey, you can smoke now. How about a cheap cigarette, right? Nice Marlboro Gold for $5, right?" Because there's a lot of support and a lot of tools that are offered by these other platforms. And, I saw, I was going for a jog the other day, and I saw ComSec offer, they were on an ad on the bus stop ad, and it was they've shifted to going, hey, we can't compete on the low brokerage, which is usually what they were, right? Now they've gone for the most powerful platform out there, right? So these things that a lot of retail investors took for granted, good reporting, good analysis, good charting, good, research. These are all things that are very in their infancies for these new startup platforms, which is just it's literally an order pad. You jump onto the platform, it's an order pad. It says buy, limit, whatever it is, and maybe a stop loss, and then you push it through. Okay, well, that's what you're going to get for that, which is fine. I'm not saying that's not an okay thing to do. But when you see the marketing campaigns of these companies saying $5 a trade, $5 a trade, $0 a trade, I think investors should just remember cheap brokerage is not going to make you any money.
Yeah. Now I've got well, first of all, you're definitely going to ruffle some feathers with that tobacco remarks. That was very much Conrad. That wasn't us. But I think in some ways your point is correct, that you're not getting all these extra things, research, charting tools, advanced orders, all that stuff. But in some ways, I think that's great. In some ways, it's the great unbundling of the financial services model. And if I just want an order pad and I want to do my own research, then keep your charting tools. Of course,
yeah, of course. And what these companies, and I guess just to take a step back, right? But what a lot of these companies have done, and they've paved the way for companies like Macro and other businesses to follow suit in streamlining and offering a good quality of service for a cheap price. Now, you can't argue with that. I'm not arguing with that, but it's just, again, businesses don't just go out and say it's for free. I definitely applaud them, and heck, we're in discussions with the same people that they're probably have discussions with, and so, like I said, they all sit in the same AFSL, right? There's great companies on the Sanlam AFSL, by the way, just as a plug-in to Werner Sowles. But no, we're in this really great, unique position in the market where retail money is driving demand. They want things cheap. They want things done properly. They want it simple. These are all great components of what we're trying to embed as well. And so, no, look, I just think investors who are serious about making money, like I said in our last episode, it's a perception, right? It's a perception that investing is not, it's not complicated per se, like you can do it, right? But just don't be naive about it, right? You're focusing all your energy on like $5 or $0 a hint or issue or sponsored. It's like, well, you know, and then you're like, oh, and then you get onto this platform, you're like, oh, what's a good stock? Well, you know, and the issue is, right, like the branding on these companies, it's like Google, Apple, Netflix. It's like, what is this? Like, it's just a bunch of companies that, you know, you can see online, like, because they're doing good things, but like, are they cheap? Are they expensive? You know, based on evaluation, it's like, what, do I buy all of them? Do I buy them in little, you know, chunks? Like this whole tech ETF movement as well that we're seeing with other fintechs that are really simplifying this. It's just like you're going to lose something with oversimplification, right? And the same way that these companies are discounting the brokerage significantly, there are things that you lose. But it is okay if you understand what you're losing and try to supplement it with you know, more research or more you know, awareness of the fact that they are making money somewhere else. Then yeah, you're fine. Yeah.
Well, look, the race is certainly on, and it's a fascinating thing to watch. Great for us.
Well, Macro's in the race.
Macro's
so
in
we'll
the
be,
race.
we'll be watching.
Unfortunately, we've had to tag along, so we'll be there.
But look, it's fascinating to see what's going on. And but unfortunately, Conrad, that is all we have time for today. We'll be back tomorrow with a watch list Wednesday, and then closing out the week with a look at what's going on in fintech. So, Ren, always great to chat stocks, and we'll be picking it up tomorrow. See you then.